Good afternoon, everybody. Can I have your attention and a very warm welcome to the Logistics Forum here at MIPIM. Welcome to your Wednesday. I hope you're braving the nicer weather today and that you didn't get too wet yesterday. Just to introduce myself, I'm your moderator for this afternoon. My name is Dan Innes from Inesco. We're an international marketing and communications agency working across many different asset classes, including logistics. So it's a pleasure to be moderating this afternoon session once again. This afternoon, we're going to be exploring a sector that in many ways has moved on from being the quiet workhorse of real estate into becoming one of the most strategic and important asset classes in the global economy. For most of the last decade, that conversation around logistics was dominated by e-commerce growth or last mile delivery and tenant demand, of course, but the context has changed. Today, logistics sits right in a mix of geopolitics, supply chain resilience, industrial policy, energy infrastructure, and capital allocation. We are seeing a world where trade routes are fragmenting, tariffs and protectionism are returning, and governments are actively encouraging nearshoring, reshoring, and strategic manufacturing. Inventory strategies are shifting. Occupiers are holding more stock. Supply chains are being redesigned for resilience rather than pure efficiency. And the real estate consequence of that is profound. So demand for logistics space is no longer driven purely by retail fulfillment. It is increasingly shaped by industrial strategy, defense supply chains, semiconductor production, pharmaceuticals, and strategic manufacturing. At the same time, the definition of a good logistics asset is evolving very quickly. For years, the conversation was dominated by ESG and sustainability credentials, but they remain important, but investors and occupiers are now asking more pragmatic questions. Do these assets have sufficient power capacity? Can they support electric truck charging? Is the grid infrastructure resilient enough for future logistic operations? Because in many cases today, energy capacity and infrastructure readiness are becoming more valuable than certification labels alone. So across these two sessions this afternoon, we're going to explore two big themes. First, how geopolitics, trade fragmentation, and inventory strategy are reshaping the demand for logistics space globally. And secondly, how the industry is moving from a purely ESG narrative towards something more operational and economically grounded, what some are now calling GSE, geopolitics, sustainability, and economics. So in other words, what actually creates value in logistic assets today? So to explore all of those questions, we're going to be joined by a group of speakers who sit right at the center of all of these changes across investment, sustainability, infrastructure, and industry. You're going to hear perspectives from global investors, occupier advisors, sustainability leaders, and logistics industry specialists who are dealing with these issues on a day-to-day basis. So our aim with these sessions this afternoon is very simple: to move beyond theory and to understand what is really happening in the logistics sector right now and what it means for capital, deployment, and asset strategy over the next decade. So with that, let's begin. And to give you a bit of a theme of the structure for the afternoon, we are going to start with a live poll. We're going to ask this question that's here on the screen: what is really driving logistics demand today, with 5 options to answer. If you look at the QR code on the top left, please take your phone, use the camera to click through to that QR link. It should take you directly to Slido. And please make your votes. Interesting, still e-commerce going strong at the top there. Nobody on tariffs, interesting. $43 votes, that's great. Any last votes? 44. Anyone making their mind up? Okay, that's wonderful. So e-commerce still driving the definition of logistics demand today. One of the things that we've been developing with this session each year is to make sure that everybody in the room gets to know each other a little bit more. So just for a couple of minutes, I would like each of you just to turn to your left and right and say hello to the person that's around the table with you, to ask that same question perhaps, and just to think about what you're going to be hearing or what you think you're going to be hearing this afternoon, and just take 3 or 4 minutes to introduce yourselves. Okay. Ladies and gentlemen, let me grab your attention once more to start our session in earnest. Thank you very much, and delighted to see the ice-breaking session going well there. That's brilliant, and I do hope those conversations continue afterwards. So it's just to introduce the first of the two sessions. The first of the two sessions is entitled Geopolitics, Inventory and the Race for Space, and we kick off with a keynote from JLL's Head of Industrial and Logistics, Guy Gerard. We welcome Guy to the stage. Thank you.
Hi, everybody. Nice to see a lot of friends and, well-known faces. For the ones who don't know me, I have a supply chain background for over 20 years, and I have had a industrial logistics property life for the past 10 plus years, not many more. One of the things we do at JLL and how we position things, and that's why we think we are legitimately speaking about that, is that we spend a lot of time, effort, resources in understanding the supply chain, because we believe that within the supply chain are the drivers of industrial logistics demand, okay? And therefore, the demand drives investment. On the first day I've joined JLL in 2014, one of the CEOs of a well-known company called Sigro told me, if there is no occupiers, there is no business. So some of the themes you will see here is articulated around occupational data, market data, that ultimately drive investments. Of course, you will also see some of the material about the global trends. We have deliberately, in a way, skipped the, how can I say this? What's going on in the Middle East just now, which is very dynamic. It changes every day. The latest we heard today, which could impact that, is that the ECB is getting closer to an interest rate hike, which is not the trend it has been going for the past 18 years, right? So we will also leave some time towards the end of my presentation for Q&A, but if you would like to shout while I'm speaking, you're welcome to do that, right? Thank you, Raymond. You're not allowed to shout. Right. we reference things as a multi-speed, but one of the fundamental message is that we are very positive about industrial logistics. There are a lot of people who think the same as us, and we will try and demonstrate that through the next slide. And the growth of the industrial logistics for a lot of space demand drivers are factual and are kicking in now. So we think it's going to grow. The second item is multi-speed. Some are more stable and robust. So the largest logistics market and the fastest outsourcing logistics market in the world is APAC. So I won't follow necessarily all the order of the size, or I'll pick up some interesting topics, I think. Europe is more moderate in terms of growth, but we think that with uncertainty, there is more and more a case for outsourcing. So people don't want to be stuck somewhere forever. So they are outsourcing to 3PLs, even if they control the real estate dimension. So that's another very important driver. Then the type of pillars that support that conviction we have are around AI. That's not going to go away. Some of you might have been at our JLL client event last night. Quantum computing, AI, there's a lot happening there. That will require more energy, that will require more industrial logistics space. Monetary policy I touched on earlier. Money is not very expensive in the main. The energy price, was reasonable until last week. But since yesterday, we went from $100 to 85 or whatever. I haven't checked this morning, but it's still reasonable. Inflation is under control. There is not a lot of inflation, broadly speaking, 2.5. The geopolitical dimension, of course, we have our tariffs from last year, and we have some of the JLL American colleagues that will be on the panel later. And that's one of our promises. Beyond supply chain, JLL is about offering a global platform. So if you have challenges or projects in APAC, in Europe, in the US, in LATAM, you can come and shop with us. So that was my sales pitch. Once a salesman forever. And then we have the Middle East conflict. Some of our strategists and researchers believe that there are three main scenarios, and I will spare you the two shitty ones. The number one and most positive one that we are backing is that it will not last forever, and the economy globally is very resilient. Think about COVID, think about Ukraine, think about the Suez Canal, and I think I might be jumping on other slides here. Think about a lot of things that have gone wrong recently, but we seem to get over most of these challenges. So the demand drivers, and one of my colleagues who is in the room here, Rich Thompson, who is our supply chain expert globally and has worked for Ernst & Young and other firms historically, will tell you that it's always a trade-off in between cost, service, and risk mitigation. Okay, so if you want if you want to have a great service, you need to have a lot of inventory. And although the inflation is under control and interest rates are not very high, that is a lot of money and to pay for. That's one of the main things. The other things on the left of the slides are in the main what I mentioned before. Okay, the only ones in the Middle East to be lucky at the moment are the Saudis, because they have a border on the Gulf and they have a border on the Red Sea. So for the ones of you who don't know, and it's not a lecture, sorry, most of the oil comes out of the Gulf, right? And the Saudis have got a land bridge into the Red Sea, which is less affected by the troubles just now. And this keynote is meant, and maybe I should have said that at the beginning, this keynote is meant to set the scene for the panels that we're going to get later, where we're going to get different views, different perspectives from investors, from asset managers, from advisors. So that's sort of trying to set the scene on where we're at. And in fact, Dan touched on a lot of very relevant points earlier in a lot more details that I would have thought. Dan, well done for preparing that. Thank you. Major trends that are reshaping the local markets. So think about manufacturing. And it's not really nearshoring. It's about, as Rich will say, it's about producing closer to where you are consuming products. And when you have a new factory moving, what you have is what we call a multiplier effect. So any 1 square meter or 1 square foot of manufacturing drives in between 2 and 3 extra square meter or square feet of supplier space. So the fact that we're moving from everything manufactured in China to a bit in China, a bit in Thailand, and a bit in Eastern Europe or Western Europe or back into the US is a great news for this asset class, right? So it's a very strong underlying trend. When you think about digital infrastructure and technology, data centers are absorbing a lot of space. So that's a very strong trend. Investment realignment. When I started 12 years ago in industrial logistics asset class, we were a bit of a, not rogue, but we were a secondary asset class. Nowadays, people are gagging to invest. Sorry, it's a French expression. They are gagging to invest into industrial logistics. I was with people yesterday, investors, they have 15 billion to invest in logistics. And there are a few of them around here, just in Cannes this week. So there's a lot of, people will call it dry powder, ready to be invested in this asset class. I think that's that. Regionalizations, and there's a bit of an explanation of what we mean about regionalization. It's about, in the main, it's about risk mitigation, because we see that the further out you're outsourcing, even if there is an apparent labor cost gain, a lot of the transportation gain is offsetting that. So last night you had Vincent Clerc, who's not French, by the way, he's Swiss, with the CEO of Maersk, saying that the cost of sea freight going up, which is actually happening now, is going to be trickling all the way down to inflation and to you and me when we go shopping. So it's not only about the risk, it's also about the cost. The long-term game about manufacturing I've touched on. We're going to be seeing more and more closer to consumption area. We're going to see more and more manufacturing. There are a lot of manufacturing leaps and changes. There are a lot of obsolete manufacturing sites that we will produce the same things or enhanced products with new manufacturing process that drive a good case for a new factory beyond moving factory A and location A to another area because of the risk, which touches to the item number 3 here. 3PL I've touched on. What we have, and that was one of my opening remarks yesterday, this year, for the ones of you who don't know, but I guess most of you know, the Chinese New Year is the fire horse. And for us in Europe, and to a certain degree in the US, before, a few months back, it's the year of the Chinese manufacturers, the Chinese retailers, the Chinese 3PL moving into Europe and the US. So Craig will tell you that 40% of the take-up in the US is driven by logistics service providers. And half of that is driven by Chinese 3PLs that nobody's ever heard of, okay? We have the same here. There seems to be a concerted effort within the Chinese economic community to support their exports to Europe, while it's a bit more challenging just now to export to the US for geopolitical reasons. But still, that drives demand. So we think it's supporting investment in industrial and logistics asset class, broadly speaking. What you see on this slide for the US and for Europe is the evolution of the share, which is the blue bit of these bar charts, of the manufacturing over some years, from 18 to 25, and it's the same direction of travel. The US went from 7 to 18. We were a bit more in Europe, which mustn't be France, all the way to 2025, it's about 27. So we see more and more manufacturing. We are busy positioning defense industry, positioning pharma industry into Europe from other sources. And it doesn't always come from China. It comes from different places. It comes through technology difference. It comes from even Turkey. It comes from Korea. It comes from a lot of different places. And the China plus N is the evolution of the famous China plus one that we used to play with. So think about one factory in China, another one in, say, Thailand or Vietnam, which is that we're going beyond that. So it's and the main area for the Chinese to set up new factories at the moment in 25 is Indonesia. There's like 350 million people there. And there is the rising size of the middle class, which will buy a lot of things that were manufactured in China, but they make them now in Indonesia. So that's on the manufacturing side. Then this is a bit of a controversial slide, especially if you are from a country that has a strong background in terms of agricultural industry and farming industry. So the Mercosur agreement that will privilege tariff-free imports from Latin America into Europe is in fact going to bring a very good support to the GDP growth in the coming years in EMEA. We think it's about half, or 50 basis points of GDP growth, okay? Which is, think about people who will be selling more cars, more equipment, and a lot of this might still come from Europe. And I think is a bit more, that's a view on the transaction volumes and what has been invested in this asset class, going back to the original question. So in the US, we are just short of 10% on year-on-year growth. 2024 wasn't a fantastic year. It did accelerate in Q4. Europe, in the main, is back. It's stronger. The APAC is still very volatile. The challenge we have in APAC is that you have very diverse geographies. You have Australia, which is a very mature market, very institutional investor market. You've got Japan with a lot of J Corp that are very strong, but it's nearly a circular economy. They work in a vacuum in a way. Then you have India, that is a powerhouse. India wants to be one of the leading manufacturing countries in the future. We have not seen everything coming out of India. And the India government now, and as a nation, are very smart about having agreements and trade agreements with the US, with Europe, with anybody and everybody. So that is, and they are not as far as China is from a European perspective. So that's another big driver for this asset class and the investment in industrial logistics. And then this slide, which I think is the penultimate one or the last one, is around the comparison in between office and the left bit of the chart. The color are messed up, but focus on the right-hand side of the chart. That is trying to tell you that there is less variation and there is more return, therefore profit, in the industrial asset class than in the office asset class, which is usually the top and the blue-eyed guy in the room, okay? And what you have, to try and balance things, is you have in the industrial and logistics asset class, like in the office asset class, you have a polarization of the market. So if you are in a great spot, in a prime location, and you have space available, you can list it. Therefore, the investment from that is very interesting, is driving a lot of value. You can list it nearly at the price you want. If you are in a secondary market location, you're in trouble. And the secondary location come very quickly. And you have some reference points and items here. I think that was my last slide. And, oh no, there's a few, what we believe are the key growth manufacturing industries, but I won't read out. So of course the semiconductors, anything related to AI. Of course, people are trying to be controlling more of their pharmaceutical industry. Think about all the challenges we had around COVID, and it wasn't even essential drugs, it was basic stuff that we have outsourced and we don't get control of. Energy consumption, the cost of energy, and that takes different forms in different places. In France, we are historically attached to nuclear energy, which is quite cheap. It has a few challenges, but it doesn't happen very often. When it happens, it's a bit drastic, but that's another big driver, and that supports the growth. And for instance, at the moment in France, there are a few RFQs going around because all our nuclear plants need to be serviced, need to be changed. We need to change a pipe here, a tap there, a whatever, bits and bobs that make the nuclear energy and the power work. So that is driving also for the next 5 years the demand. It's new plants of people who make the equipment that is needed. It's spare parts, okay? Another thing that is here is automotive, which is not only good for APAC, but is also relevant for Americas in Europe, is that when you buy a car, even if it's a combustion engine, the OEMs are committing to a 15 years spare part availability. So that's one distribution and supply chain for spare parts. Now that we have hybrid and batteries, you need to have a second and sometimes a third distribution channel at the same time. So that drives demand for space. So overall, we think it's a fantastic asset class. I hope there's nobody from any other asset class here. That was all from me. I can take a few questions, and there are a few colleagues from different parts of the world that would be also able to answer. Thank you. Thank you, everybody.
Great. Great. If I can welcome up the panelists for our next session. If you could please take a seat in the order that you see them. That would be, see your lovely photographs. That would be amazing. Guy, thank you again for wrapping up. Where's Guy gone? There he is. To kick us off and just to start on some of those broader topics, but we are going to dive into some things in a little bit more detail. Could you go this way, actually? Okay, great. Just from your left to right, we have Sonia Gonzalez Valverde, who's the board member and former head of global real estate for Shell Asset Management. Welcome, Sonia. Then next to Sonia, we have Craig Meyer, possibly the furthest traveling member of this panel come across from LA, who is the President and Global Chair of JLL Industrial. Welcome, Craig. Then we have Hubert Michalak, who is President of Hillwood in Poland. Welcome, Hubert. And on your far right, we have Ingo Steves, who's the Managing Partner for Logistics at Swiss Life Asset Management. Welcome. Good to see you again, Ingo, as well. Great. So, as I kind of alluded to in the opening sequence, even 5 years ago after COVID, that race for space was mostly a story about leasing, and it was for e-commerce, delivery speed, network densification. But today it's more about geopolitics, tariffs, although tariffs had no votes, but we will cover that. Trade fragmentation, bit of corridor risk, defense expansion, and reindustrialization. But what a few weeks we have had globally, and our thoughts are with anybody whose friends, family, colleagues are impacted by the conflict in the Middle East. I am going to pose a few questions down the line, and I'm going to come to each of you for some responses. And the first question I'm going to kick off with is about inventory expansion. And to ask that question, which I know that a couple of people I heard talking about before today, was, are we moving structurally from just-in-time logistics to just-in-case logistics to become a little bit more or a little bit less speculative? So what would make this uplift and shift into something a little bit more permanent? And from the pre-call that we had, I'd love to come to Craig to talk about that first of all, because I mean, in the US, you know, the portion of inventory growth has been pretty structural versus cyclical. So what are you seeing in terms of changing from just in time to just in case?
That's kind of a complex question and answer. And I go this way to say, we've had some short-term shocks. So let's go back in time a little bit. COVID was a massive event that will be recorded in human history as something unique. We did, in the United States, 5 years of leasing in 1 year. And that was because everybody shifted to getting things at home. We've gone back to a more balanced economy where people are going out and doing things and going places. But that shift's been more or less permanent in its nature. I'll give you a couple data points. One, pre-COVID, the United States, 11% of all retail sales were online. It peaked over 20 during COVID, a really short period of time. Went down a little bit as people went back outside, and it's on its journey for the US going to probably 35% of all sales online over another 6 to 7 year period. So the tailwinds, and that's why that e-commerce number came in, the tailwinds on e-commerce are undisputable, and it will be a continuing driver. In the US, this means pushing goods closer to the customer. Being delivered overnight is now becoming ubiquitous, temporarily. So we've had shocks that have come through that have been geopolitical in nature. You know, Liberation Day was about a year ago, where they announced tariffs. And the immediate reaction was knee-jerking, and began to realize that rhetoric on one end didn't necessarily wind up being policy. They were changing day to day. But what was the response to that? Well, we've seen a lot of inventory piling up because you wanted to get stuff in transit to avoid any tariffs that were coming. So it was an immediate reaction like, let's cram it in. And there was paralyzation for a while. How did that result for us in the US in terms of real estate demand? I'll tell you that the fourth quarter of last year was unbelievable in leasing. For JLL, December of last year was our second largest month in volume in the last 20 years. Only exceeded, I forget if it was 2021 or 2022, the peak of COVID. That says something by itself. I just got our numbers for the first 2 months of the year. We're up 33% in activity year. So it's continuing. This is really a push. And I don't want to take all the time, so I'm just going to say there's a couple things about that. One, I think American corporates through the year began to realize, and you use the word resiliency, that life goes on. Things have to happen. We're planning for 2 or 3 or 4 years ahead. You have to begin to making those investments today. So they got rid of being paralyzed. So I'll stop with that because I want to give some time to somebody else.
Well, thank you very much, Craig, and it's brilliant to have you come across for MIPIM. Thank you very much to give your perspective. Ingo, can I come to you and ask you from a European capital markets perspective, what's your view?
Yeah, I think I'm absolutely with Craig. The fundamentals for European activities for logistics, for supply logistics, are really getting better and better. Historically, we are again on the average leasing up of logistics space in Europe. In Germany, in particular, we are again at 5 up to 6 million square meters in 2025. That is the same take-up levels we had in 2016, 2017, and that's a good sign for everybody who was involved in logistics development and investment. I think from our point of view, there are a lot of new drivers coming in for logistics. It's always the same. Starting the business 25 years ago, I think logistics was not that the hottest asset class, no, in Europe. Prologis came to town in 1998, make it really logistics, everybody's chocolate. And now we have investment in anybody's portfolio at 30%, 35%, even getting bigger and bigger. All the risk Guy has mentioned in his very great presentation, I think that are structurally the demand driver for logistics space. We see rental growth in particular markets. We are covering with Swiss Life Asset Managers, one of the leading logistics platform here in Europe. And for us, I think the times ahead are quite bright. So everything is good.
Awesome, thank you, Ingo. And Hubert, especially in Poland and Eastern Europe and elsewhere in your portfolio, how are you seeing this demand, and how quickly the shocks that Craig referred to, how are they translating into leasing demand?
Yeah, of course, I mean, the shocking sudden demand absorbs the vacancies. We are not talking here about very sophisticated premises or buildings that require lots of time to be delivered, developed. Automation is not available for the prompt reaction in this type of cases. But clearly, the demand is there. The vacancies go down. Rents potentially, as a consequence, might go up or stabilize at satisfactory levels. And clearly, this translates into the positive investment atmosphere around this part of the commercial real estate sector.
Mm-hmm. Great. Sonia, anything to add before we move on to another topic? Just in terms of the shocks that Craig was talking about and how that's translating into demand.
Well, I think that's pretty clear, considering that most of production chains are now very global. So a lot of every product has input from different parts of the world, and as such, what producers or even retailers don't want is to have a shock that they are not able to access certain parts of their production or stock because it's in a place where there is a shock, as we've seen through COVID or now through what's going on in the Middle East. So that, I think, is the result of a bit whatever we call it reshoring, but a bit mounting a bit of stock so that there is no crash on these supply chains. But and we see that as a structural consideration because we see these shocks constantly in different parts of the world.
Mm-hmm. I think it's a good point to move on to things like trade fragmentation, because we will talk about tariffs at some point in this afternoon's session. But I mean, in terms of the way that trade is being pulled left and right by different shocks, and just thinking about how nearshoring and reshoring and regionalization is changing that location strategy, certainly across Europe. I'm going to come to Ingo first from your German perspective. What is that trade fragmentation doing to, or what are you seeing across, firstly Germany, but then across your wider portfolio?
Yes, I think especially for the German manufacturing scenery, we see a lot of coming home, nearshoring, but we see again a trend of decoupling. That means coming back home, but as well investment in US and in China. I think that is not only the new trade policy. It depends for sure on the board members of the manufacturing companies, how they are deciding to go for. But still, the structural driver, e-commerce defense, is a new driver for us, and that is quite a good one for us here in Germany.
And Hubert, I'm just thinking about, one of the countries in your portfolio is Poland, very important, bordering with the Ukraine. And, in terms of trade fragmentation, how are you handling that? Or what changes are you seeing specifically from the last 3-4 years?
Maybe on the reindustrialization, one comment, and then this nearshoring. To be honest, we were expecting much stronger activity on the industrial output being brought back to Europe, in Poland as well, as a interesting, attractive destination for placing production activity in Europe. However, this does not develop as fast. We see some activities, we see some signs. Probably the shocking events will still boost this trend, and given the broken supply chains, still positively impact the relocation of certain activities back to Europe. However, as clearly the whole production it's impossible basically to bring it from Asia. I mean, we will definitely see lots of light industrial assembling activities to be brought closer to the consumers, and this is clearly happening.
Speeding up that delivery cycle. And Craig, what's your view of nearshoring?
Well, we don't like that term. We like the term regionalization. So just quickly, if you go back in time, you mentioned Prologis opened in 1997. I'll ask the group a question. How many warehouses did Amazon have in 1997?
One guy can answer this question.
How many?
Raymond.
97. Maybe with 0. I think they opened in 98. How many do they have right now? Several thousand. They occupy 750 million square feet, the largest occupier in the world. So quickly, what's the change? We went through a period of globalization beginning at the end of last century for 25 years. In the United States, if you looked at our manufacturing numbers, they dropped pretty quickly. We were exporting a lot of manufacturing into China, low-cost provider. What's happened towards the last 5 years or so is the cost differentiation isn't there. Labor costs have gone up, sustainability and other things like that. Child labor laws have changed, where it's made it more expensive. So naturally, some things began coming back. There was also a bit of quality control on some products. So I think that's been a change that we call regionalization, is because, like the car companies in the United States, 6 or 7 years ago began building big plants. BMW makes this X5 in Spartanburg. Mercedes-Benz is assembling in Alabama. Toyota's in Alabama. Nissan's in Tennessee. Toyota's in Texas. So all these things are happening because they want to get closer to the customer. So that's the trend that we tend to see, which is a natural thing of economics and global trade. I would tell you that COVID also taught us a lesson, and this is repatriation of essential services. Pharmaceuticals that were being made, generics abroad, the United States, we got to have them here. We got to have all those things here. And then the other thing would be geopolitical, where the decision was made that in like the TMMC that's in Phoenix, making of chips. So we cannot make these chips that will be used in defense and other things that could be either pirated or the security wouldn't be good. They're going to bring them back to do those things. So I think for us, we see those things as kind of the drivers. So similar around the world. I think that the other question is, I think new trading blocks are being created. I think ultimately you're going to see a lot of diversity in Europe. And as things will, because you're going to be almost like a new free trade zone compared to the United States. So, and I think you'll see that shift continuing.
I think you're touching there on that defense topic, Craig. And, I think this increased pressure, principally coming from the US to countries around the world to invest more in defence, and this sort of rearmament and every part of the industrial chain involved with defence, we've got to start thinking where does logistics fit into that? What are the demand sides for that in terms of security, secrecy, compliance, power, labour? I'm gonna come to Sonia first to talk about that, because it is a broad topic, but it's been brought into sharp focus in the last 10 days. What's your view on European defence spending, and what's your view on it?
Well, it has been clearly announced that there is an increase in budgets across the board in Europe for defense spending. And I mean, it was initially done by Germany last year, but now, I mean, you see all the countries, France, the UK, really beefing up their supply and their all their, the defense expenditure. And actually what we see is now, so I was talking this morning with AXA and you see Redefco in the UK and AXA in France, they've actually identified all the areas where they have the defense and maritime, aerospace, and all the different parts of defense where they are actually beefing on logistic space and demanding more logistic space, either for storage or for production. But it's not only weapons, it's also like drones and all the different aspects that the defense industry requires these days. So you see managers already.
Are you thinking, Sonia, that defense is becoming more or less investable as a result? Because are there capex implications, complications essentially, or do you actually see this as an opportunity and you're all in?
I think when we look at logistics, I mean, this is now a much bigger part of the portfolios nowadays of investors than it used to be. Back in the years I started looking up after logistics back in 2007, and was indeed, as was mentioned before, not the place to be. It was very minoritary. It was retail was the place to be honest. Now the whole ball has shifted completely, and we see in clients' portfolios is now 30% of the allocation goes to logistics. And if you have that, what you want to have to build a resilient portfolio is a diversified income base. So having different industries that support your allocation to logistics, that is not only depending on e-commerce or not, or 3PLs, but also on infrastructure. There's also requiring a lot of logistic warehouses close by these infrastructures that is being built. Defense in different locations, actually, that is not the traditional logistics or distribution locations. All this is really enriching the allocation to the sector and making it more resilient and solid.
Hubert, can I just come to you quickly on some of those points? Because on the ground in your portfolio, how are these additional security requirements having an impact on like site selection, location, or requirements?
Well, first of all, I think that this huge investment program deploying massive capital into the basically production increase within the defense sector will generally boost European economy, and logistics and commercial real estate within I&L sector will just benefit out of it. And it does not really mean that investors, developers will suddenly put their capital into ammunition factories. I would even say it's unlikely that happens, but the general industrial activity will definitely impact the logistics sector and demand for more space on the inbound side, supporting the various elements and components, supplier side, etc. And And on the building specification, these are just industrial buildings, and in theory, they would be much simpler comparing to very advanced e-commerce facilities or data centers. It's just huge, relatively universal whole that shell that can be developed and ultimately within a long-term perspective being converted into different logistics use.
And Craig, if I can come to you from a US perspective, have you been experiencing and seeing this defence investment for perhaps longer than we have been in Europe? And what kind of examples could you give?
I don't know if it's been longer, but it's been big. And we've done some massive transactions. We did a big deal in Columbus, Ohio, which was selected because of population and available labor and suppliers. But it'll be a 5 million square foot plant for Anduril that's going to be making military drones and things. Similar thing happening in Long Beach with them. We have a big project in the middle of Texas. It was an old aluminum extrusion plant that had all, it could create its own water, power, everything. Highly popular with those people doing that. So absolutely think that there's going to be a growth in that. I think just, to be morbid, when I was reading yesterday some note on, well, there's going to be an increase in munitions manufacturing because the U.S. has, spent $2 billion on bombs in one weekend. So I think they're going to be building more of those, So the answer is yeah, I absolutely see it. In our own book of business, manufacturing's tripled in the last 5 years. And forecasting future requirements is up to 20% of what we're looking at. So I think all of that's kind of interrelated, to be honest with you.
Ingo, just jump in on that.
Many thanks for that. I think the institutional underwriting for standard box, the underwriting standards is set up by Prologis, I think, as the industry standard, clear height of 12 meters, 2 meters door per 1,000 square meter of gross leasing area, everything else. At the end of the day, it's a simple shoebox where you can store a lot of things, and you need to look what kind of products you would like to store. Just give you an example in respect of the defense industry. Everybody from us has seen the movie The Boat.
Many times.
Many times. Yes, that's a good one. With the periscope, looking from the sea to the next target, for example, the periscope. I think it's not an issue for any institutional investors to store that. But assembling the machine to bring this periscope to the U-boat in Kiel, it's a maritime system of ThyssenKrupp, for example. That's a different kind of beast. That then you have military services, which is needed. A lot of more capex to be spent, but everything in front of that, I think, Sonja, you can easily handle by Maersk or somebody else who can do this services. And as you know, especially here in Germany, we have some issues with production of raw materials at all. We need to have a clear picture. What is our spec? What is the business behind that? Is it already a weapon, or is it something a stage before? And institutional investors need to be agreeing on it, because institutional money is the most core money we need as a developer. We need to convince the guys, I don't know how it is, Greg, in the US, that is already accepted that defense is an occupier in your warehouses. We as the life asset managers do not have any issues with that, but lots of German institutional investor pension funds, they have question marks about that. Question to you, Frank. Yeah.
I can understand that.
Yeah. And then just keeping with the theme of this first session and inventory, and about thinking around strategic stockpiling, which also we've seen a lot of change. Craig touched on it at the very beginning, and Guy also post-COVID. But what we're trying to think about what role logistics can play in that kind of, in some kind of resilience strategy, because we're seeing logistics as a go-to class now, as a much, much more critical asset class. But just thinking, Sonia, if I can come to you first from a corporate lens, do large industrial energy businesses already treat this kind of stockpiling and inventory management and increase in emphasis on an inventory and stockpiling as part of business continuity? But how does that translate into location and specification of these assets?
Yeah, so the Shell Asset Management is investing the money of the pension fund, so it's just not that much related on the energy aspect of it. But basically, the way we've seen it in our portfolios is that, and talking to our managers, is that even in stockpiling, Chinese retailers, for example, are actually stockpiling in Europe now because they don't want any disruption of being able to deliver. So I think it comes back also to what we were talking earlier about the disruption in the production chain and so on. So yeah, there is a bit more of stockpiling, not to get, to be able to go through disruptions like even the tariffs, that we saw a lot of other overseas parties bringing assets to the, earlier than the tariffs were coming into place. We've seen, indeed, as I said, Chinese leasing warehouses in Europe just to have stock here in Europe. So we're seeing that increasingly, yes.
Well, to your point then, Sonia, let's go to Hubert, because what's your experience in your portfolio and managing assets that see that more immediately, on the stockpiling and inventory? Are you seeing huge changes and huge demands in usage?
Yeah, stockpiling. It was mentioned about China. I think it's this is what we're seeing, the massive operations of the Chinese retailers bringing massive amounts of goods to Europe, absorbing substantial part of the vacant, immediately available spaces. But this is just the consequence. This is just the reaction to the expected changes on the tariffs. We are now discussing the huge requirement of the Temu company in Central Europe. This Chinese retailer is now looking for up to 1 million square meter warehouse space, not necessarily very sophisticated, relatively simple activity to put their goods locally to be ready to deliver. And it's a requirement that should be absorbed within the next 24 months. One location, preferably.
If I may, I think that what's interesting to us, so we've taken a hard look at what's driving the rise of the Chinese 3PLs, and our conclusion has been that there's an unstated policy that the Chinese are going to own every aspect of the supply chain. So if you have a Chinese good, it's going to go to a Chinese 3PL. It will go to a warehouse that could be owned by Chinese investors to get to the end customer. And I think that's a long-term strategy. And if you look at how they're structured today, you mentioned the TMOs and the others, and JD, which is doing a big amount of delivery, and it's the only Kano, I never get that name right, is one group. They're owned and have these customers. The new ones that are coming in are going to be, they're less transparent. They're usually on the landlords, so they don't have any credit because they're all forming Cayman Islands kind of stuff. But those are part of ultimately expatriate capital coming out of China. If these groups can invest in material handling equipment, trucks, and real estate as a way, and that capital can stay out of the country, and they have a real favorite tax thing on it. I don't know how long that'll last. Any of the state-sponsored ones, which would be like Costco and the big shipping companies. I think that's a fundamental change that we're going to look at as being long-term. It's just This just isn't a moment in time, it's a shift in time to see that. We haven't seen that in the US because typically the 3PLs have been either homegrown or big globals, and now this group's coming in. That's just an observation, a comment on how we see stuff.
And Ingo, just thinking about municipalities and governments looking at inventory and stockpiling, and are we seeing in the EU and Germany a potential for some mandates coming up from government level to improve stockpiling, and what impact is that having?
Absolutely, and we see a lot of drivers from that respect. The government, the bodies of government are looking for big logistics hubs, and we are again in competition as a developer for sites. So I think that makes an investor developer successful if you can convince the municipality that you are the one who have maybe the government behind you to get a long lease agreement, maybe for the closest for military, for example. There are a lot of demands at the moment in Germany, and it's a good thing at the end of the day. It's again a demand driver for that, and municipalities like that kind of stuff, even more than maybe an e-commerce company from China. It's better to have maybe Amazon or Procter & Gamble, or a Mercedes or somebody like that, because the Chinese business can end very soon if the EU Commission decides to have some trades on all the good flows. The show is ended. So I think from the sustainability point of view, if you have an existing stock, yes, these occupiers are much more welcome, because you have a vacancy rate in your portfolio, and any cash flow is more than welcome. New builds, I think you need to look exactly who is your occupier at the end of the day. There are some occupiers like JD, that is JD.com, that is the Amazon from China, for example. They are very strong. I think they make the same like you did with Amazon, the first rollout from 1998 until 2012, 2013. They're doing the same, I think, now in Europe. They're buying retail, for example, Media Saturn. They're going now in e-commerce. You, as a developer, can sell the whole development portfolio to them, for example. They are quite strong. I think it's reality, or there's a competition for e-commerce, which are coming to Europe as well. At the end of the day, a lot of drivers. We are at the beginning of the new cycle here in Europe. As Guy has pointed out, all the drivers making rental growth, NOI growth. And I think, Craig, at the end of the day, that's the most important thing.
Yeah, I mean, Greg, can we assume that it's a similar story in the US to that Ingo's just described, that's impacting European logistics? Is the same thing happening with municipal government? Yes. Sorry.
Municipal government less.
Sorry, great. Yeah.
Yeah. No, I think that our government policy is pretty erratic right now, so it's hard to predict. But I'm going to tell you, I'm here. There's a lot of American developers. By the way, if you didn't know that Hubert, he's a good old boy from Houston. That's where Hillwood's based.
Dallas.
Oh, Dallas now? I thought you were in Houston. Anyway, he's a good old boy from Dallas. But I've been here. There's been a number of American developers who are here looking at opportunity in Europe. Why? So look, whether we like it or not, trade alliances have changed. And I think in many ways, while they're not going to be way over here, they're going to be permanent in nature. I think ultimately that's very good for Europe. I think new alliances will be made. I think they're looking, and by the way, we live in a global world. You take a look at, you talk about Prologis, or you talk about Blackstone, you talk about all these massive global investors are everywhere. And capital will go wherever it can find yield. So they're backing that up. And I think they're beginning to see opportunity here as I think trade and other activities is going to grow. Ultimately, will be good. There's going to be creating new trade alliances, and we'll have confusing ones in the U.S. for a while. But I think that's ultimately good for European logistics businesses.
If I may just add something to your point, because you say Amazon is a good customer now. I know, but 1998 when it started to 22, nobody liked us.
Who were you?
GDP, for
but
example.
yeah, you need always a good developer, Raymond. No, who
I'm
has,
just saying things are
oh,
changing. So
who
maybe
has-
Chinese companies in
Yeah.
2 years we're talking differently.
yeah. If you control the site, no, if you own the site, if you manage the site, if you have a great presentation with Amazon in front of the municipality, no doubt about it, we can make it. No, we made 1 million of square meters of Amazon in 60 months. No? And that is absolutely possible. E-fulfillment center, the big ones, the 250 million of ticks, 60% market share, no? And the last mile logistics, that was quite a little bit challenging because it was size-wise, it was not a great investment. But anyway, I think a good story with Amazon, it's always fulfilled by a good developer.
Yeah. Well,
But also what is mentioned, what we have to mention here is a discussion about Germany. There are other markets in Europe where the municipalities do not participate in a discussion about who is the ultimate occupier of the building. Of course, the discussions with the municipalities, negotiations with the municipalities are sometimes crazy, and this affects the delivery timing of all type of logistics buildings, and the same applies to US. I mean, the regions where the protests are occurring, and basically the deliveries are restricted. Nevertheless, only wealthy communities can afford to protest new developments.
It's quite the opposite in the U.S. It's not the wealthy communities. It's oftentimes like in the Inland Empire, the local people that are there, the local workers and things are complaining that a warehouse is going next to a elementary school and things like that. So look, U.S. is, if I understand the code, we have a lot of restrictions. And I'm from California. You know, it takes you 2 years to get entitlements to build the buildings. You buy the land, you can't start construction for 2 years.
Craig, especially, if you compare the New Jersey market and the Empire market, that's the strongest market in the US. But if you go, for example, to Texas, Houston, I don't think that you need a building permit. No? You can.
Well, that was the story in Houston for a long time. They had no zoning.
Yes, and you cannot
You
have
want
a
anywhere.
stable business plan in Texas, because anybody can build the next warehouse, the next warehouse, the next warehouse. No?
It's a dynamic area. You fly into Dallas right now, there are freeways under construction, hospitals, colleges, and everything.
Yeah.
It's a dynamic area. A lot of things are flooding there for a reason. And they're probably the best business-friendly location in a central time zone of the United States.
Well, let's finish on this exact point, this one about the supply response, because the pipeline that we've talked about, the speeds and the constrictions on that, the shocks that Craig mentioned have had a real impact on demand. But can we prepare better with our supply response? And I think that the pipeline for cumulative demand, it has certain constraints, land obsolescence, which I know was a big point that Craig mentioned on our pre-call, construction costs, labour. You mentioned about the location for that drone shed, Craig, as well. Infrastructure and power. We are going to focus on power more in the next session. But I mean, how do we set up a supply, for a supply shortfall, and some kind of response for, with a rental regime, because I'm going to come to Hubert on this one first, because, where do you think the bottleneck is for supply now? Is it permitting? Is it ESG? Is it, is it land? What's stopping you building a shed for Amazon in 18 months like Ingo has?
Yeah, hopefully it's not ESG. I mean, it's land. I mean, for sure, but it's the developer's role. I mean, we have to identify the right spots. We have to start working on the land, assemble the land, run the entitlements, negotiate with the municipalities, persuade them to accept this or the other investment plans, create the in exchange creating the tax base, because the logistics is a tax base for many municipalities. So for sure, the land and then utilities is another very important element, and energy, and not only the fact of its existence, but also the quality of the energy. The grid has to provide the certain level of the redundancy, and then the quality for the very sophisticated equipment to be installed in that buildings. Same with the heating, the gas, I mean, etc., road access, infrastructure. So these are the elements that basically drive the fact that it's really, it takes much more time comparing to the past to deliver the proper modern logistics space, but creating such pipelines, and I'm sure many developers do it across the globe, basically, they just address these needs.
And Craig, are you seeing this supply gap in the US narrowing, or?
Oh yeah, yeah. Look, we responded to COVID. A lot of buildings being built or being absorbed. Interestingly enough, it's like going into a market and there's a couple of loaves of bread on the shelf. If you pick that particular product that you want, there may not be another one. So we're seeing, people call it build a suit, I call it build a size. There are certain markets, if you need to get a 1 million square foot building in the Inland Empire, where there might have been 12 available last year, there's only 2 remaining. If you don't get one of those, you're going to have a building built. If you drop under 500,000, you might have 15 choices. So it's really particular to the local markets and what's being absorbed. And on the bigger sizes, there's been a reluctance to build a big ultra boxes over 1 million square feet. So that's kind of hesitated. But we'll burn through this. I think we expect the vacancy rate in the U.S. to begin dropping by mid-year. So that means that very little is being delivered, and this will begin absorbed.
It's currently around 7%.
Yeah. And look at it, again, if you look at any trend line before COVID, we were building, and we were kind of in stasis. We were leasing 250 million feet a year and building 250 million feet a year. And it was a pretty stable market. It popped up. We're reverting, I think, to that period, that we have pretty good discipline. The financial institutions apply good discipline on it and risk aversion on that. So I think we'll hit that kind of equilibrium, be down to 5% in the next 18 to 24 months.
And Sonia, just thinking, what's your view in terms of supporting your managers to narrow this supply gap?
Well, I mean, provide capital to start with, but I think also one of the issues is indeed availability of land in the locations where we're going to be. I mean, not everywhere you want to have your logistic asset or industrial. And power is not always available where it is. So you see countries like the Netherlands very constrained, both in power availability as well as land. And you have others like, France or Spain, where, you can get power in 18 months. Well, in the Netherlands it's 8 to 10 years. And also land permit zoning is easier. Mm-hmm. So there is more land available. I mean, not certain areas, but others, yes. So I think indeed the ability to have capital in advance so they can go and look and chase, and in most cases we see them assembling small sites in order to build over time that required bigger sizes of land and in the locations that it's required. Mm-hmm. But I see power as a big constraint.
Yeah.
In particular because the requirements of power are larger now.
Yeah. I think Thomas Steinmüller's keynote is going to touch on that as we go into the next panel session after this. We're out of time. Do we have any time for Q&A, by the way? Matthew, Amadou? We do? So, do we have any questions from our, I guess, hello, right? Do we have a microphone, or do you want to project?
Anybody on the panel that would like to address this? Guy kicked this off by saying, he's very positive on the industrial real estate, the demand for industrial real estate. Outside of regional wars, and trade geopolitics and the economy, what is the one thing that keeps you up at night in regard to the positive demand for industrial real estate outside of the big macro regional wars and economics? What would be the one thing that could upend the demand for industrial real estate?
I'll go first. I'm very concerned that there's going to be a limited amount of French burgundy coming into the U.S. And I need that.
Who wants to take that question then?
Yeah, I think if you compare, for example, Craig, Richard, US to Europe, Europe is a very fragmented market. No? You have absolutely the power, no? Because what you do in efficiency, you see what warehousing or what institutional money is surrounding US. It's absolutely magnificent. In Europe, you have a lot of nations, you have a lot of municipalities, you have even here in France, we discussed it, how many champagnes are here, I don't know, 2,000 or something like that, it's magnificent. You have to have a team in place who understands the regional aspects, to delivery space, to convince the municipalities that you are the right partner, that you have the right customer behind, that you are well equipped in equity and everything else. That is what we are going to do. I think the demand drivers are there. It's maybe a little bit weak from the demand side at the moment, but it's picking up again. I think to make land banking possible, and that you can really, Sonia, tell you as our maybe a potential customer that we can deliver the space within a time frame of 18 months, and it's secured that you can start your operation in 18 months.
So
all the requirements,
support, so government support,
the building permits and everything else. It's a complex procedure here in Europe, in different jurisdictions, but that makes it interesting. We have in the research, the last word on this done, is a factor model, and the barriers to enter in submarkets here in Europe. We discussed that, Richard. It's something different in Rotterdam, it's something different in Munich, in Hamburg. It's again something different. What are the demand drivers?
Do we have any municipalities in the room here? Anyone? No one is prepared to put their hand up anyway.
Yes, and that makes a difference, and that makes me wake up during night.
Yeah, interesting.
So the driver for logistics, there are two key drivers. First is consumption, and then the consumption remains stable. It's just a reflection of the general GDP, I would say, and then even given the ESG policies, we should rather consume less than more. And the other one is industrial production. The production drives a lot of demand, and it was also presented in Guy's slides that this is an outperforming factor that drives the demand for logistics. And as Ingo said, Europe is fragmented, that's right, and there will be certain regions that would benefit of various factors like system of transportation, certain labor availability issues that would benefit and would grow logistically, while the others would be less attractive and then potentially will suffer even some vacancy issues. But Europe is changing, so you have to spot the right future stars in order to keep growing.
I would just add that indeed limited power availability. I mean, there are some regions in Europe where that's a big problem, and even any logistic operator requires now, because of the electrical vans and all this kind of stuff, a lot of power, increasing power. So that's, I would say, it's also a big thing in certain areas.
We're going to unpack that a little bit more in the next session, but no, Sonia, I don't want to stop you.
Well, I gave you a glib answer before, but
more burgundy.
More burgundy, always. That would assuage everything. But The answer, seriously, what worries about me is there is unintended consequences of current policy that result in a catastrophic black swan event. And what I mean by that is, in the U.S. financial press, you're reading that we're in an overvalued stock market, or something happens there that causes some real big shift. We've been resilient through some things, but there's a limit to it, in my mind. And we'll burn through this readjustment, I think, but we can't constantly have these massive shocks. Enough is enough, really.
I think the sector's showing good agility, but yeah, let's not have too many shocks. Do we have another question? Microphone here, thank you.
Oh yeah, just a quick one. My name's Rob Jones. I work for a company called CTP. We talk a lot about, or we have talked today a bit about increased defence spend and how that is expected to translate into incremental demand in the industrial logistics space. I wonder if anyone, either on the panel or indeed in the audience, has any example at all of defence sector leasing that they can point to in the last kind of 12 months or so? And if not, how do we translate what should be an opportunity for us in Europe into incremental demand for us in the sector?
Craig, you mentioned one deal.
Well, I'll tell you, the Anduril deal in Columbus, Ohio was...
Ideally in Europe, if possible, but...
Okay.
We got just one occupier within the defense sector, and it's purely logistics for some non-military components that are kept. We got a couple of million square meters inventory across Europe, and this client occupies maybe 3,000-4,000 square meters.
Yeah, from a general perspective here, we've had some. We're working on a plant in Poland from a Korean, in the defense, Korean corporate in the defense industry. We also have a couple more projects from some Turkish defense manufacturers, and these would be on the more, I would call it, active side. Then what you have also is with the increased spending on the defense sector, you have a lot of non-active military budget spend, and we are tracking one in Swindon that is in England, which is pretty big. I can't remember the numbers, but it's over 500,000 square feet, because we can't see it there. It's more for equipment than active ammunitions or whatever. So there are some really active demand in the market, and we only one other players that tracks that. I'm sure there are some others.
Was there any others? Anybody else in the audience who has that example? Or Ingo? Sorry.
I think we have a very educated audience here. When you look at the drivers of logistics space demand, it was e-commerce. That is still some great driver at 40%. If you look at defense, it will be at something about 10 to 15% of all the demand. If you given the turnover here in leasing up in Europe, we are about 20 million square meters per year. That means we are at 1.5 up to 2 million square meters. But we are at the beginning of that. We are now producing clothes, assembling weapons and everything else. I think that will be really some more to be done. We see in Germany that some production facilities from Volkswagen will be giving up to Rheinmetall, for example. There will be the production of military vehicles, but saying this kind of things needs to be stored, but there's no tender outside in the market from Johnson & Johnson or everything else that they need warehouse space, but it's only a question of time that we will be doing that. So I think overall we need to look at it, but e-commerce like Amazon, like Zalando, like GD are still the main drivers for that.
Completely agree with that. I think I've been talking to our managers, and they see increasing leads and requirements for that, and they say it's over the next 3 years that's going to be the theme. But also you have in the Netherlands a VDL that was a producer of the minis, now is doing some drones for defense industry. So it's mainly indeed a lot of automotive factories being converted into services for the defense industry.
Absolutely, the beginning. I think we can describe it. The European defense industry are about to putting the machine together. No? Let's see what's happening. And then I think we need to look at the specs as well, what we can really do in storage. Is it only assembling, or is it really making a military weapon? And then let's look how we can go forward with that. No?
Perfect. Well, guys, thank you very much indeed. I think that's been fascinating, a very topical. The geopolitical landscape has been on everybody's minds recently, but I think to find a sector which has been impacted so greatly as logistics, I think it's fantastic to have you all on stage to debate that. So thank you very much to our panel. Sonia, Craig, Hubert, thank you.